This is a video from TradeGainers.com, created to help you understand what equity is and how it works. While the images and narration may differ from the original version, the content remains true, always based on data and science, with ethics, responsibility, and the support of an expert team with extensive experience. What is equity, and how does it work? Equity is one of the pillars of financial markets. When we hear about stocks, the stock market, or investing in companies, we are essentially talking about equity. Why is it called variable? Because returns are not fixed or guaranteed, they depend on how the company and the market perform. As a counterpart, there is fixed income, which can be considered loans to governments or companies. In that case, you know in advance what interest you will receive and when, for example, a government bond. On the other hand, in equity markets, shares represent ownership in a company. When you buy shares, you become a shareholder. Your earnings depend on whether the company grows, pays dividends, or its stock price increases. If the company performs well, you earn more. If it doesn't, you may lose money. There are several types of equity, such as common shares, giving you the right to dividends and voting at shareholder meetings. Preferred shares, giving you priority in dividend payments but less voting power. ETFs or investment funds, bundles of shares managed together to diversify risk. These equity instruments are traded on stock exchanges, organized and regulated institutions that facilitate the buying and selling of shares transparently and securely. Even though today most operations are digital, each market still has a physical headquarters and fixed opening and closing hours. Because they operate in different time zones, there is practically always a market open somewhere in the world, allowing continuous trading and information flow. The stock market works through supply and demand. Prices go up when many want to buy and fall when many want to sell. To buy or sell, there are intermediaries, brokers, and digital platforms that connect investors to the market. There are also custodians, often banks, and auditors to ensure everything follows the rules. The official regulator in each country, such as the Securities and Exchange Commission, oversees the promotion, supervision, and control of the market based on its securities market law. To understand how the market is doing, we have stock indices, which act as a thermometer of the market. A stock index is a statistical indicator that reflects the performance of a stock market or a specific sector. It allows investors to assess the general market situation in a single chart. Indices are composed of a basket of selected companies, usually the largest by market capitalization, and their value changes according to the performance of those companies. In other words, stock indices represent the performance of a group of selected stocks to show whether the market or a sector is going up or down. For example, the S&P 500 tracks 500 large U.S. companies, while the Nasdaq focuses on technology. There are also sectoral indices, energy, healthcare, consumer, which serve as benchmarks for analyzing specific trends. Examples: IBEX 35 in Spain, S&P 500 in the US, and Stoxx 50 in Europe. Many factors affect equity markets, such as companies' financial results, the general economic situation, inflation, interest rates, growth, news and market rumors, collective psychology, fear or investor euphoria. This means equity involves certain risks, such as volatility, potential losses and market downturns, and the need for knowledge and discipline. On the other hand, it offers advantages like the possibility of high returns, dividends, and participation in economic growth. In the next chapter, we'll talk about how to invest in stocks. Follow us on our website TradeGainers.com, the financial geoportal where you'll find much more information and real-time analysis. And please remember to like this video.